Many individuals share concerns about their financial well-being, and US banks are issuing warnings of a credit crisis looming larger than the 2008 financial crisis. Unfortunately, this crisis is unfolding at a particularly challenging time for American households. Credit card issuers are tightening lending criteria, making it increasingly difficult for consumers to secure loans or access credit. In this video, we discuss everything related to this ongoing crisis. Please make sure to subscribe to the channel and leave us a like below this video. This tightening of standards comes as more than 3 out of 4 households, or 77%, express anxiety about their financial situations, as revealed in a recent survey conducted by Capital One and the Decision Lab. The financial strain on US workers is evident, with the cost of living at an all-time high and wage growth failing to keep pace. Real average hourly earnings have actually declined by 3.6% since January, and as of August, 60% of adults find themselves living paycheck to paycheck, according to data from the US Department of Labor. These statistics underscore the widespread financial challenges affecting a majority of consumers. Let us know what you think of this below in the comments. Lending Club's money expert, Senator Lee Dunham, aptly sums up the predicament, stating that there's more month left at the end of the money for many. Millions of seniors are delaying retirement due to insufficient savings, middle-class workers struggle to afford their children's education, and financially vulnerable families are grappling with the difficult choice of whether to allocate funds to food or rent each month. These challenges are driven by stubborn inflation, rising fuel and food costs, and elevated interest rates. Notably, it's not only about making ends meet, it's also about escaping debt, which is becoming increasingly daunting for young Americans. This is particularly detrimental in a job market marked by scarcity and the burden of soaring student loan debt, hindering them from achieving the hallmark of adulthood, moving out of their parents' homes and living independently. In fact, almost half of young adults now reside with their parents as they grapple with low wages, student loan obligations, and limited purchasing power. CNBC reported that in 2023, 23 million or 45% of all Americans aged 18 to 29 are living with family, a rate not seen since the 1940s. While the importance of family cannot be overstated, it's safe to say that many of these young adults would prefer independent living if they could afford it. A significant driver of this trend is the exorbitant cost of housing and rent, with the average monthly rent standing at $2,052. To avoid being financially burdened by rent, the average renter needs an income of $6,840 per month after taxes, and yet around half of the nation's renters exceed this threshold. Housing prices are equally out of reach for most Americans, as a recent report found that home prices in 99 out of 575 US counties are beyond the reach of the average income earner. Mortgage rates have surged, with the average rate on a 30-year fixed mortgage reaching 7.4%, requiring an income exceeding $125,000 to qualify for a loan to purchase a $400,000 home. From 2019 to 2023, median-priced U.S. homes have soared from $313,000 to $416,000, representing a $103,000 increase in just 4 years. In essence, the median home price now stands at a staggering 530% of the median annual income, with median house payments consuming a record 49% of pre-tax income. This affordability crisis is permeating the entire economy, contributing to an increase in personal bankruptcies compared to the previous year. As a result of these financial setbacks, more Americans are relying on credit cards to cover essential expenses such as rent, utilities, and groceries, in addition to larger purchases, marking a significant departure from past spending patterns. A few weeks ago, Wallet published a study that raised concerns about the financial strain faced by average American families, drawing parallels with the Great Recession as a reference point. This study pinpointed the projected breaking point, which represents the threshold of household credit card debt that becomes unsustainable for most individuals. According to Jill Gonzalez, an analyst at Wallet, this breaking point occurs when people are no longer able to keep up with their bills. She highlighted that while credit cards can provide a means to defer essential payments, they are also one of the costliest ways to borrow money, with current annual percentage rates, APRs, averaging around 24.25%. This high APR translates to an extra $3.4 billion in interest charges for credit card borrowers over the next 12 months, as calculated by Wallethub. The New York Federal Reserve recently disclosed that the average household now carries a credit card debt of $10,170. In the past quarter alone, nationwide credit card debt saw a staggering increase of $43 billion, marking the second largest surge on record. However, the ability to obtain loans has diminished, with 60% of respondents in the New York Fed survey of consumer expectations stating that their loan access has decreased compared to a year ago. This decline is attributed to the credit crisis that banks have been warning about, which has already begun manifesting. Credit card companies have been reporting substantial losses due to rising delinquencies in credit card debt. Borrowers are grappling with mounting challenges in paying off their balances in full each month, exacerbated by the excessively high APRs. Rolling over balances to the next month only leads to further debt accumulation and long-term financial hardship. In aggregate, Americans now owe over $1 trillion in credit card debt, reaching a record high. Goldman Sachs recently reported that financial losses incurred by credit card issuers due to delinquencies and defaults have surged by 3.64% in the past 3 months. Analysts at the bank anticipate a further increase to 4.93% in October. The rate of increase has been rapid since early 2022, resembling the trends observed during the 2008 financial crisis. Ryan Nash, an analyst at Goldman Sachs, predicts that the wave of delinquencies has only just begun and will likely peak in late 2024 or early 2025 for most issuers. With more banks adopting stricter lending standards, many consumers, particularly those who rely on overdrafts to address short-term financial needs and unexpected expenses, are becoming increasingly financially vulnerable. While overdrafts offer a degree of financial flexibility, they come at a steep cost. This not only affects low-income consumers but also impacts nearly 70% of higher earners who spend beyond their account balances, incurring fees. Payment issues have led to additional financial hardships for 90% of respondents who struggle to cover account charges. Moreover, around 70% of overdrafts have broader repercussions on credit accessibility. This situation has put additional stress on already struggling banks, heightening fears of a full-blown credit crunch. Such a scenario, characterized by reduced access to loans with onerous terms like abnormally high interest rates or stringent restrictions, can have detrimental consequences for consumers looking to purchase assets like cars and homes, businesses seeking to expand, and overall economic stability. Retailers are already grappling with credit issues, with credit card delinquencies featuring prominently in recent earnings reports, as seen with Nordstrom's specific focus in its recent financial update. CEO of Accrue Savings commented that retailers are signaling the pain experienced by a portion of the American population who are struggling to make credit card payments. When consumers face financial difficulties, co-branded store credit cards are often the first to see delinquencies. The slowdown in lending from banks is expected to further exacerbate economic challenges, making the downturn even deeper. Mark Zandi, chief economist at Moody's Analytics, anticipates a significant tightening of credit in the near term, particularly among small and mid-sized banks. In preparation for potential turbulence, banks are increasing their cash reserves, a move that differs from the typical practice of investing customer deposits. Silicon Valley Bank faced issues related to its investment in long-term U.S. Treasury bonds, which lost value due to aggressive interest rate hikes by the Federal Reserve. To avoid a similar fate, banks of all sizes are prioritizing strengthening their balance sheets, even at a time when many Americans are in need of loans. According to Mike Novogratz, CEO of Galaxy Digital, a credit crunch in the U.S. is imminent, and the market is already pricing it in significantly. He emphasized that banks are taking every possible measure to survive this challenging period because there won't be a safety net or bailout from the Federal Reserve if more institutions fail. This time, a bailout is not on the table, and would undo the progress made in lowering inflation from 9.1% to 3.7%. For over a decade, the U.S. gross federal debt has exceeded the gross domestic product, GDP, each year, a concerning trend. As of September 22nd, the federal debt was equivalent to 120% of GDP, indicating that the government lacks the resources to respond to a crisis as it did during the 2008 financial crisis. If more individuals default on their debt and financial institutions continue to falter, there will be no safety net to prevent an economic collapse. As the looming debt spiral grows, the risks for all Americans become more pronounced, and the consequences of government inaction to address this catastrophe become increasingly severe. Time is running out, and it is imperative that action is taken to address these pressing financial challenges. Thank you for watching.